Hi, I'm Mark Recession, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our macroeconomy show, and we're going to talk about how things are going, what's happening, what are the big movements that are hitting the market today. And we've been talking significantly about rates, what is happening with the 10-year, what is happening with China, how is that going to impact things. And we want to break that down once again into our normal 5 categories. So in the first segment, we're going to talk about how global debt maturity wall is coming. And each bond has, or loan has, a natural expiry. When does it mature? And the problem is, as it matures, it either has to get fully paid off or it gets just rolled. And as you see rates going up, well, the cost of rolling goes up. So we want to look at what are some of those impacts that we could see throughout the on a global basis and how that's going to impact growth. Then in the next segment, we're going to talk, in segment 2, we're going to talk about why the Fed will raise rates again, why we think there's at least one more rate hike, and what is going to be the impetus of that. And in terms of why would they do it, given where some of the economic indicators are going. But then at the same time, when you look at inflation, and then we're going to tie that back to the 70s and why things look similar and how they're different, but also the same. Then we're going to finish up the U.S. talking about retail sales, talking about how they did surprise to the upside. We have called, I think, 15 of the last 0 slowdowns in retail sales. So we want to look at, okay, well, what is the retail consumer doing? Where is savings? How is savings impacting their spending? And what is that going to look like going into year end? Then we're going to switch over to Europe, look at how inflation picked up again. It's not surprising in comparison to where the U.S. is, where we think things are going to go, obviously, as we continue through August. And then we're going to finish up with Asia, and we're going to talk first about China, how the impacts are continuing in terms of the rate issues, why we're seeing this pressure point when we're looking at the yuan, the exchange rates, bonds in general, and then realistically kind of culminating with what are the issues in the real estate market, why is that such an impact to their specific economy, and then connect that back into what's happening with India. India had a huge increase in inflation. You have Japan, which had a very weak auction, which is a bigger problem because for those that have been watching us, we've been saying that Japan was really going to be the first, in our opinion, developed market to have a failed bond auction. And what is that going to look like? And what is the ramifications, not only for the Japanese bonds, but also for the yen? So here is where we pivot over to, okay, well, what is the impact of interest rates? What is the impact of what is happening in the world today? We look at the 10-year, which is, I should say the U.S. 10-year bond, which is now over 4.25. And the problem is the 10-year bond is used as the benchmark for a lot of these emerging markets. And as the 10-year goes up, the cost of borrowing goes up. And a lot of things use it. High yield uses it. Emerging markets use it. So when you start looking at the global fixed income maturity profile, you get an idea of the impacts, because as those rates go up, if you can't pay back your loan or your bond or your debt, you have to roll it. But it's going to roll from what may have been 3% up to 7%. So your cost of that debt is going to increase, and that's going to put more pressure on the business, which may increase leverage, because everything is going to have a different profile. So say, for an example, it's like, okay, you took a $100 million loan, or and the loan is expiring, and because the loan was, let's call it at 5%, now it's going to be at 10%. It's like, well, based on your business, I really can't give you $100 million. I can give you 75, because you're going to look at the LTV. You're going to look at that long-term value and what the actual valuation is going to be of that asset. And you're going to have to say, okay, well, this asset is now technically worth less because of the leverage, and because of the revenue, so I have to discount the amount I can give you. So that's also going to take away some of the borrowing capacity, or the available borrowing capacity against an asset. And that's why there's so many different pieces that really come into how this can be impactful and why this is going to be the case, because that 10 years, it means so much for so many of these different pieces, from global markets, emerging markets, from different loans, and then obviously high yield is going to be obviously, if you're high yielding, it means that you're a growth company. You don't have established markets the same way. Where IG, your investment grade, IBM, Microsoft, Amazon, Google, investment grade. But obviously, when Amazon started, they were high yield. They weren't investment grade. So that's where you start to look at some of these different pieces, and then the loan. So you get an idea at how much is going to be rolled in this period. And for what we believe, which is that rates are going to stay higher for longer, it's going to have a much bigger impact over that time period as we get some of these rolls. So then when you start looking at, well, why would it stay higher? You just look at the central bank policy. So when you look at the global central bank, you see that we've continued to get hikes. We did get a cut from Japan, which is absurd. And we'll talk about that in segment 5. China has also cut, which is again another issue that they're trying to get in front of, with Chile and Brazil doing something similar. But when you look at the trends on the trend on CPI, which is looking at inflation, the trend for Japan is higher. The trend for Brazil is higher. So it's difficult to start cutting rates when you actually have inflation reverting up. So that's why we believe that rates are going to stay elevated for longer, trying to tamp down some of these pressure points. And but as you do that, you're increasing the cost of borrowing. By increasing the cost of borrowing, that's obviously going to continue to put pressure on these economies and these underlying companies. But for some reason, the recession expectation for the global economy is fading. But why is it fading? There's a view that we're going to get a soft landing, as you can see, based on August 2023. There's an increased view of no landing, which just means that we never have a recession. We never have a slowdown. Well, we have a slowdown, not a recession. But when we look at the market and we look at the debt issues that are sitting there, there's a broad problem when you start looking at the maturity cycle, where rates are, and how that's going to impact growth going forward. And this is why we've been talking so much about this anchor pulling everything down, is because you're sitting on things, just sitting on top, and that's going to essentially be a big problem going forward when you look at what that growth is going to look like, especially as you start to layer on or try to roll some of this debt. Now, we've had some additional information in terms of days between billion-dollar disasters, and these are two important pieces that we've talked about. So they're saying, as their 1980s, the average between billion-dollar disasters was 75 days, and in 2020, it's 18 days. Now, the problem is inflation, density, cost of just doing anything. So it's hard to say that they're equivalent. So it's kind of a misnomer, because you really have to tag that to inflation, because if inflation's going up, well, of course you're going to have less damage, but that'll cost more. Especially when you look at where people are moving. If you just look over the last 40 years, people moving into Florida, into the Gulf of Mexico, into Texas, into floodplains. And this is just looking from 19 and to 20 to 21 to 22. You had over almost double the amount of people moving into flood zones. You had, same into fire, into heat zones being places that are going to risk water scarcity. So most flood-prone U.S. counties saw 384,000 more people move in than out in 2021, 2022. That's a 103% increase from the prior 2 years. But then on the other side, you have the devastating data from National Oceanic and Atmospheric Administration shows that 2020s are averaging only 18 days between each billion-dollar disaster. Cost of each event is adjusted for inflation, and disasters include droughts, flooding, cyclones, winter storms, wildfires, etc. So, but what does the inflation look like? Because if it's adjusted for inflation, and this is to split hairs here, but I think it's important, if you adjust for inflation, as in the headline number, well, for anybody that's trying to build a home, you know that the cost of rebuilding that is well above the headline inflation number. So again, there's and you just get a density. You know, if there were 5 homes in this floodplain in 1980, and over the last 40 years you went from 5 homes to 5,000 homes, well, you're going to get a much bigger impact, and you could even get a smaller impact, but it's going to have a higher cost because of that density capacity. So that's why it's important to put a lot of these things in perspective when we're looking at some of these different pieces. Now, when we look at the contiguous U.S. average temperature, just in the from the NOAA, even with the data shifting, July 2023 in the U.S. is the 11th warmest July since 1895. So the 1979 number that's quoted is using satellites. This is looking at things over that time period by core samples, the like. And you could see from 1925 to essentially 37, you had that big heat wave, which created the Dust Bowl, created the droughts. And now you're getting something similar. But one of the things, how do we get any pullback and reprieve? And that's going to be an interesting one to watch in general, because when you look at weather shifts, droughts, and then obviously the amount of people moving into these locations that are exasperating the already finite resources, you're going to create additional problems in those zones. And that's why when you start looking at these inflationary pressures, these maturity walls, then you look at where the people are moving, how those disasters are striking. Well, global ending stocks across major food groups is continuing to move down. Now, people, whenever I say that inherent yield is down year over year, people will say, oh, well, beans are up or this is up. I'm talking across the whole chain of food, because people are going to replace. If I can't get rice, I'll buy corn. If I can't buy corn, I'll buy wheat. If I can't get either any of those three, well, where am I going next? So there's always a replacement cost. So sure, if maybe corn yields are down, but soybean yields are at a record. So I'm going to convert over. But when you start putting all of these replacements together and looking at it in time, you get an idea at what we've been talking about since 2016. Since 2016, we've had a continuous, essentially decline of what is available in the market. The problem is, the world population is going up, not down. So you have food that is capped and falling, and you have a rising population, which is increasing those impacts. And the U.S. is not the only, and it's not just a global problem, it's a U.S. problem. The rate of household food insecurity in the last 30 days has drifted up just slightly, but the rate of household food insecurity by food satisfaction level is I think a better way to look at it when you're looking at that suffering side, because how do we address that in the U.S.? Well, we give support, and that's when you start looking at the SNAP benefits. So we never get to the point of stress, because if you get to that point, you can go out and you're able to get some sort of subsidy, whether that be food stamps or the SNAP benefits, or some other, where in other countries you don't have that same capacity. So that's why we've talked so much. I think it was 2 or 3 weeks ago, we showed the insecurity levels and how we're moving into a level 3 risk, into a level 4. And the U.S. is no different. And the reason why we talk about the U.S., because we are the richest country in the world. We are capable of feeding ourselves, but yet you're seeing more fear and more issues in a place that it should be able to feed itself. And that's where we continue to see some of these stress points. Now, the percentage of U.S. imports it continues to change. So when you look at some of these stress areas and why we think some of the global growth is overstated, we start looking at China, because China's share of U.S. goods imports has declined since 2017. Meanwhile, we're obviously importing more from Mexico, EU, UK, but it started in 17, and this is what we've been trying to talk about. I've probably, you've heard me say it on multiple different occasions. I was going to get a BS in a BA in economics. I wanted to do FX and rates, and we had to do a dissertation. And I talked about globalization and how globalization was going to come full circle, and you were going to start to see this pivot. And this just shows, again, from 2017 on, you saw this pivot, and then obviously COVID, and then closing of the labor benefits of being in China versus elsewhere, continue to tighten things up. Now, emerging and developed countries are now the dominant emitters of greenhouse gases, and this is a problem because right now we're sitting here in the U.S. We're doing something, so we're trying to address the fact that there's more disasters, but we're also moving into the disaster zones, but we want the world to be cleaner, but it's really not, we're not doing it to the same degree. But again, things build up in the atmosphere, and we have gotten better over time. And this is why when you look at the Sustainability Development Goals, or the SDGs, they talk about equity, equal equity, and how do you create equality and equity at the same time? And that's what we're trying to address when we look at Soltec, providing a value add fertilizer that is a yield enhancer, soil amendment, but also cheaper. So it's cheaper than the alternative. So a farmer in Africa can afford it the same way a farmer in Ohio can afford it. But if you look at drones and these other types of things, or these AI components, well, an African farmer may not be able to afford that. Some poor farmer that has 50 acres can't afford a drone or some AI technology, but they can afford products. And that's why certain products, which is why we talk so much about equity and equality when we're looking at our investments from a C6 perspective. High income countries contributed obviously the lion's share of historic emissions, but when we want other countries to catch up and increase their quality of life, it's important to give them solutions that we didn't have in the 60s and 70s that exist today, that can increase efficiency and try to keep us from emitting more over that time period. Then when you look at some of the different pressure points, because all of this culminates because everybody's green until it's expensive. So then when it's expensive, well, how do I offset? And that's when you start looking at housing, which is a big way to derive value for a local individual. So when you look at the real home prices, disposable income, that's as you start to see that come down, the ability to invest, the ability to provide support to these emerging markets diminishes because you're worried about stuff at home, and homes and housing is a big link to, well, what is the consumer going to do? What is the economy going to do, especially at the developed market level? And then you have rates going up, and then you have the maturity wall. So we're trying to show here everything's connected. Everyone likes to talk about things in bubbles and pockets and vacuums, but they're not. Everything is connected, from the commentary on insurance costs, because we're not saying that the $1 billion isn't true. It's just we're moving into those areas, and people are paying for insurance, and rates are going up. So then the insurance companies have to pay, which is money not going elsewhere. And it's something that can only be afforded in some of the richer areas. Some of the poorer areas, they don't have the ability, as we talked about in the amount of savings available, to put down the deductible, because the deductible, they don't have it in savings. So then what? Well, the insurance company you're either going to sit there until you can pay the deductible, or there'll be some sort of foreclosure, or you'll be forced to sell because you can't afford to rebuild. And that's when you start looking at these pivot points, and this is where everything is connected in a different way. That's how we view the world. That's how I view the world, where you can't push on a string and assume that there's no other impacts. There will always be millions. Some of them you see easily and directly, some of them indirectly, some of them can be a fourth derivative away, but there's always that impact. Just like when we look at U.S. remains the hotspot for semiconductor designs. Why? Because we protect patents. We have fantastic patent laws. There's a very clear method that you go through. There's a very clear way to fight those if there's an infringement. So it's an easier place to secure, and a lot of countries will rubber stamp our patents, because if you get a patent in the U.S., it is viewed that you've done everything that you could, so therefore you will get that protection, which is why the U.S. continues to be that beneficiary, and that's something that China's wanted to go after, which is why they've talked significantly about the importance of design and equipment. But they don't have the best patent protection. They don't have the best ways to protect IP, which is going to hinder some of that newer growth. Now, they're trying to dump money into it and investment, but as they clamp down on entrepreneurs and private enterprises, it's like, well, I could either go to China or I could go to the U.S. Where am I going to protect my IP, which is what China's tried to get away from in the 2013, 2014 when they were trying to attract people with PhDs back to China, was clean up the atmosphere, provide solutions to protect their IP. But instead, again, the U.S. continues to be the preferred place because of that. So that's what we have for you on the global piece. In the next segment, we're going to go deeper into what is happening in the U.S. and why we think the Fed is going to continue to raise rates.